All right, Michael, this is your area of expertise, not necessarily mine. Residential real estate is your world. So we got lots going on right now between tariffs impacting import costs potentially, between interest rates being volatile as all get out, where are mortgage rates going? Tell me, where is this residential market going here in 2025?
So I get asked this a lot because obviously is the one rental at a time guy, big in real estate, residential specifically. And there's really, so let me give you the brass tacks. So I think 2025 residential real estate transactions will be worse than 2024. And to my knowledge, I'm the only person calling that. And just so we can put some numbers on it, 2024, we went down at 4.06 million. This is all existing home sales, so excluding new homes. And I think that existing home sales will be sub 4 million. Now, why do I think that? I think there's a couple of things. First and foremost, I am somebody who studies history. And we do have a historical precedent that when rates were raised, what happened to residential real estate. So you can actually go back and look at my free spreadsheet on my website and go back and look at 1978 through 82. Actually, I think I have it ready to go. I don't know if you've seen this.
This thing's awesome. I've spent time in this thing.
Yeah. So let me just see if I can bring it up for the audience. So here it is. Good. It's working. Technology is working today. So what I want to ask people to do is look at existing home sales. So I will just highlight that yellow. And again, I wanted to look at 1978.
3.96.
Yeah. So what happened is it took multiple years for us to find the bottom. And the bottom was 4 years later in 1982.
Yep.
Right. So, and then again, you could look at interest rates, all of these things and see that interest rates went up, right? From 1978 again to 82. So again, it's a historical precedent. Is it perfect? No, of course not, but it's a historic precedent. And then I fast forward to today and I ask myself, how many years have we been in this? And it's only been 3 years. So again, looking at historical precedent, it tells me that we probably have one more year left.
Okay, so talk me through this. In the 1970s, rates got much higher than they are now, to state the obvious. When rates peaked and then descended, did it flip the script quickly?
Yes, it did. Every year after 82 was better than the year before, but here's the wrinkle.
I was going to say, there's your chink in the armor, but you're going to answer it.
Yeah, so the deal here is it did get better, but it only got better when you compare year on year. So 83 was better than 82. 84 was better but 84 was not better than 78.
Right.
It took us until 1996 to get back to and exceed existing home sales from 1978. Nobody understands this.
Okay. Let me ask you this though. So why then are you making the argument that this is going to be worse than last year when rates in effect should be lower?
Well, that's the rub. I don't think they will be lower. I think everybody is anticipating rates being lower because that's what the market is telling us. I believe, at least for the first 6 months, you are going to have chaos, and I can't imagine rates breaking 7.
Understood.
Right. My average call for rates is 7%, and the market's just frozen at 7%. You get until you unlock the move-up buyer, Taylor.
Right.
Housing can't heal itself.
Right. So let me ask you another question. When you talk about chaos, what do you mean by that?
Well, I think we have a new president. President Trump is in office, and I think he is. And I told people this before inauguration. The next 6 months are going to be chaotic, and generally speaking, the bond market and all of that doesn't like chaos. So that said, I think there's a margin of the chaos effect. I think it gets better, July on. But again, I think rates are sticky. So,
and let's clear up one bit of confusion. You do this all the time so well, but what the Fed does not impact mortgage rates. And we've talked about this in the past. The Fed affects the front end of the curve. If they cut, 2-year treasuries might come down and anything inside of that. But the longer end of the curve, mortgages are based on the 10-year. And what you had, interestingly, last week on Friday, was you had the market come out and say, we actually have seen the biggest movement higher in inflation expectations that we've had in a number of years. And this is Jerome Powell's favorite line. inflation expectations remain well anchored. That's his
Exactly.
favorite line. Now, where does that go now that inflation expectations don't seem to be well anchored via the University of Michigan report?
Yeah, it took a bit. This is all why everybody calling for rates to be lower and transactions to be up, they're missing. They're missing the time lag of all the chaos, the tariffs, the this, the that, the deregulation, the tax cuts. All of these things are just going to keep 2025 messy and push the goodness. Because again, I think 2026 residential housing is a bang up year, right? Let's say we do 3.9 million in 2025, just as an example. We might do 4.3 or 4.4. Now, again, that means nothing when we did 6.6 4 years ago.
But it's a 10% increase from last year.
Exactly. If you are in real estate and you survive 25,
right,
you are going to gorge in 26.
And what do you think that pickup is a function of? Do you think rates come down in 26? Is that your expectation?
Well, it's really twofold. One is, yes, I do believe rates will be sub 7 in 26.
Okay.
Probably sub 6.5 when you average it for the year.
Okay.
Still
I see what you're doing. Yep.
But the big one, Taylor, is consumers have taught us that they can stay in a place that's not perfect for about 3 or 4 years. Right? Then the bunk beds don't work anymore. I mean, it's just how life works.
The third kid needs their own crib in their own room.
Yeah, it's just life comes in. You get tired of being in the same space. You just want to move. And again, that all of those are coming together to make 2026 an up 10, 15% transaction year.
And when you talk about the ability to stay in misery, obviously hyperbole there, but in a tougher situation for 3 to 4 years, is that your gut feel, or is that something that you've seen before in the past, or where does that come from?
Again, it's just the 54-year spreadsheet just tells you that. Again, you could look historically. Existing home sales went down 50%, but then they were on a decade-long trend of moving higher.
So, Michael, you're telling me that people should look at history?
Yes, shocking for clues. And it's really funny you bring that up because, again, you talk about interest rates going up a lot before, but in context, it's on a percentage basis, rates went up higher this time.
Correct.
Right?
Yep.
Right, on a percentage basis.
I think we've just seen a very interesting move out of Scott Bessent and Donald Trump. In the fact that they said,
bring that up. Yeah.
I mean, it's a magnificent, and this is where they could be smarter. Like out now, this is just a better understanding of the markets, and it might be Trump, or it might be Bessent, or
I don't think it matters as long as they're saying it. It doesn't matter.
It doesn't matter because what they're saying, and I think this is what you're alluding to, agreeing with, is they did not beat up Jerome Powell for not cutting interest rates.
They said he did the right thing.
Did the right thing. And everyone's like, whoa. Like, you were ready to cut his head off last time around when he wasn't cutting rates and raising rates or whatever he was doing. You were like, cut. But now what they're doing is they're focused and saying, guys, 2 things are incredibly important. One is our national debt and how we term that out. We're focused right now. We issue debt inside of 2 years at hyper speed. It's all incredibly short term. And so if you cut interest rates, that does massively bring down interest rates when you're issuing 2-year debt. But they're like, let's start to lengthen this out some and issue 10-year debt. And therefore, we just saw last year where they cut interest rates and the 10-year part of the curve pressed higher. So it's that second level of thinking that I'm going to give some credit to Bessent here, hedge fund genius. He's like, listen, we're not doing this right. And he totally bucked the Apple trend. That's not right, but you get the point.
Yeah.
He totally bucked the Apple card or whatever it is on the historical thinking of how we issue debt and what levers to pull to make that advantageous.
Yeah. Specifically what Scott Bessent was quoted as saying is we are focused on the 10-year note. That is the right answer.
Right. Agreed.
Right. So
and you know what though? What to give Trump credit, Trump was the one pounding the table last time around at issuing 100-year debt.
100-year debt. He was right.
And he was 100% right.
He was right. So the reason this is important, and again, why I think 26 is way better than 25 is it's going to take a while for the market to see reality because focusing on the 10-year versus the Fed overnight rate is the right idea. 100%.
Correct.
So how do they do that? How do they lower that? Well, they've got to lower inflation expectations, right? They just took the largest jump on record.
Yeah.
That's going to take time. And I have an answer for that. And the second one is they've got to bend the curve or flatten the curve or whatever the right word is for our stupid national debt.
Yeah.
So I think
I'm
they're
interested
doing
to hear your thought on that, because dictating where the back end of the curve goes is not something that's an easy task.
Well, actually, I do think it's easy. I actually think it's remarkably easy. So let's do the first one first, because then we'll probably be more conversations on the latter. So the first answer, lowering inflation expectations. Again, consumers are remarkably simple. If we could get oil to $60 and gas prices fall 50 to 75 cents, inflation expectations will collapse. It's just how people work.
Yeah, I think controlling oil is not as easy as what maybe you're perceiving it to be, because we haven't seen much of a movement downward in oil prices.
Well, it went from 80 to $70. It went from 80. That's not zero.
No, that's fair. But I think that there are more factors at play there, where if you start pressing further and further down, you all of a sudden have the impact of OPEC going.
Yeah,
okay,
you can't go below 60, because then they turn off, and you've done. It doesn't help. It's not helpful below 60.
Yep.
So that's the first one. Now let's talk about the other one. Now, you think it's hard. I think it's easy. And the reason I think it's easy is all they have to do is take a runaway train that's now $2 trillion a year in deficit and show how that curve is slowing down and ultimately bending. It goes from 2 trillion to 1.8 to 1.6 to 1.5. And then, oh, by the way, you get the tailwinds of, oh my God, they're doing it. Let's lower the back end rates. And then it helps more, because instead of issuing 10-year debt at 4.6, you can do it at 4.3 and 4. It all becomes good. Now, how do they do that? There's only the federal budget is just like your household. There's only 3 ways you do it. You increase revenue, AKA tariffs.
Yep.
B, you cut expenses, fraud, grift, which is becoming, it was estimated in the All In podcast that there's 600 billion to a trillion of grift, theft, stealing in the budget. So let's just say it's $500 billion, just because it makes the math easy. Let's assume that's found over the next year and a half. That's 25% of what you need.
Yeah. I don't think that that's an easy task, right? We're trying to make broad stroking. I'm less optimistic on the fact that we can just trim fat very easily for 2 reasons. Sure. One is broad stroking. Hey, take this payout and leave. Like that's not targeted. That we need targeted, right? That's the important part. And targeted is hard, right?
Of course.
And then the other part of it is what happens when the biggest employer that's been adding jobs over the past 2 years flips and becomes now a layoff machine. And private sector has been laying people off. They've lost 1.3 million jobs over the past 18 months. So all of a sudden now it's like, okay, when you're trimming fat, it also could be slowing down the economic flywheel as well. Just as people don't have jobs, they're the only ones adding right now. And you see Meta right now laying off. You see Microsoft laying off.
Well, what happens if the job market falls apart, Taylor?
Well, rates come down, but at the same time, then tax receipts fall as well.
Yeah, tax receipts fall as well. So I just did some math. So it was rumored, again, all this data is not, I don't know, but apparently there were 20,000 federal employees who accepted the 8-month buyout. Did you hear that as well?
Yes. And that was what, like 2%, something like that?
Yeah, it was a tiny number. But again, let's just assume it's 20,000. I had to do some math. So I assume that the average federal employee makes 90 grand. No idea if that's right. It's probably in the ballpark. 20,000 times 90,000 is $1.8 billion.
Yep.
Let's call it 2 billion. So again, none of this is fast. None of this is fast. But it's to me, it's like, it's just 1,000 paper cuts.
Yeah. But again, my point is like, that's 1% of the goal of a $2 trillion cut. And that's easy. That's saying, okay, if you want to, take this payout, one, it doesn't cut the deficit at all for 8 months.
No, of course.
But it does cut potentially productivity.
Well,
Which
it's all about, again, that's why it's bending the curve. This is about fixing 2020, like 2025 federal budget is baked. It's done.
Yeah.
Right? This is about making 26 better.
Yeah. So I guess with all this having been baked in over the last month, what is your thought on why inflation expectations have moved up remarkably?
Because I think the media has been screaming about tariffs, and they think that all these other things are out there, and that's going to make things more expensive. I don't think people realized that the 25% tariff. I mean, we had this discussion last week. The 25% tariff on Mexico and Canada, I thought was a tool.
Chess move, right?
Yeah, it was a chess move, and others thought it was, everything was going to get more expensive. Like avocados at Chipotle were going to go up, right?
All of a sudden now we're buying $12 avocado. Like, that was
exactly.
bombastic, right? Yeah.
Yeah, it's
annoying. It's annoying. It's not meaningful. There's a difference.
Right. Exactly. So I think just a lot of people don't understand the use of tariffs by this administration. I undoubtedly, like this steel and aluminum tariff, I think that's legit and real and coming. And we can talk about that here also. But I think a lot of these are just to get better behavior between countries.
Better terms.
Yeah, better terms for us, which I think is a net positive. So at the end of the day, I think interest rates, why I think this is the last hard year for housing is I don't think interest rates move meaningfully lower until, call it Q4 or Q1 of next year. I think there is a lot of chaos for the next 5 months that are just going to keep.
Can I ask you one more thing?
Yeah.
When, how, if do we get some compression on the spread over the 10-year? The difference between the 10-year Treasury rate and what is actually being charged on mortgages. One of the explanations that I have seen that bears some merit is the fact that interest rates are so volatile that they have to widen out their margin as a bank just to have a margin of safety there. And if we stop getting the volatile interest rates, they can compress that to more of historic norms that are 1.5 to 175 as opposed to 3% or wherever they are now.
Yeah.
I see some logic to that. Is there anything else that I'm missing there?
No, I think what actually will help do that this year, and I think the spread currently is 265. I checked over the weekend, but still, it's 80 points higher than normal. To your point.
Yep.
So how does that get smaller? One is I do think what we need is quarters of flat rates, relatively flat rates, which we've had for 4 months now, right? Rates have basically been 7%.
Oh, you lost me. You're talking about quarters of the year of interest rates basically doing nothing. Got it. Okay.
Yeah. So we need more of those. We need more time to be flat. And that
does cause that compression. That's where that margin of safety takes place.
There's another step.
Okay.
So yes, less very volatile means they can collapse spreads because they don't want to have refi risk. That's what these guys are worried about, right?
Right.
So again, flat rates help with that. It's also the reality is flat rates at 7% are going to tank their business. Loan originations are going to fall. Refi demand is going to collapse, and they're just going to be competitive. They're going to have to lower the spread to eat. That's the answer.
Yeah. And if it'll be funny to see how much more of a black market, if that's even possible, could potentially develop. BDCs, business development companies, were loan basically originators to companies when banks got really stringent post 2008. It proliferated an entire industry of, smaller investors pooling money together and they're going out and saying, hey, you're good enough. And they get a little better terms, right? But they're producing loans. And is there a way to come in? Probably not, with a new industry here. And if rates will remain elevated, that spread was too wide, can some other area of the market come in and interject?
Oh, it's already happening, at least at some scale. Again, I have conversations with lenders every week. And again, this was true last week. I don't know if it's true this week, but conventional loans last week, you could get something in, 7%. There's this other product called DSCR loans, which are non-traditional banks that investors typically get. They're like 6.5.
Interesting. So I'm not, educate me on this because this is something that's foreign to me.
Yeah. So again, DSCR loans, and again, I have receipts, Convoy Home Loans, go look at their playlist, going back at least 9 months where DSCR loans, riskier products, were cheaper rates. Now that does come with some caveats. larger down payment. Typically, conventional loans average 8 or 9% down when you have them collectively. Right. A DSCR loan requires 25% down, so there's more skin in the game, which again, less risky, right? So that's why you're getting your cost of capital. Also, typically DSCR loans will come with a prepay of 1 or 2 years because again, they want to de-risk interest rates. But yeah, if you are finding an investment deal that cash flows day one, and you're an investor, a DSCR loan is a half a point cheaper today. It blows people away.
Well, even more than that, right? Because an investment mortgage right now is going to be higher than 7.
Oh, that's true. It's probably like 7.5, 7.75.
Yeah.
Yeah. So DSCR loans are cheaper. It is a market. To that end, again, because I talked to them, the largest provider of DSCR loans in 2024 is out of the market. Now, why would that be?
I was going to say, okay, either they filled their coffers and they don't have any more capital to deploy, or they made some bad decisions and realized it's not a great business.
I think both are true. So again, they pulled out in early December. I have receipts. And the thought was they're just done. They've allocated all the 2024 capital, right? It's December. Let's go party, blah, 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 blah. But now it's February. They're not back yet. And there's no talk of them coming back. So what I think happened, and again, this is my opinion. I have no facts, but I think they got full on what's called STR or short-term rentals. Think Airbnb.
Yeah.
And there was a time where STR was the hottest thing going in the market. Unfortunately, my guess is they took on a lot of Palm Springs and other markets, which have been decimated by new regulation.
Yeah.
And their loans are shit.
Well, also, you look at it from an investor standpoint, and if they're going out and collecting capital from whomever, and they're saying, hey, we'll get you a 6.5% ROI on this, or you can go out and buy Apple debt at 5.5 or 5 3/4. It's like,
exactly.
There's essentially no risk here. And there's the risk of who is this company that's vetting these projects and filling up a portfolio with God only knows what.
I think it's even
I don't know
worse.
if there's a big enough spread, which is all comes back to the point of like, this is why rates are as high as they are. It's a measurement of risk. If you're lending to Apple at 5.5, are you lending to me at much less than 7? Probably not.
No, Taylor, I would not do that.
You? No chance. You're 14.
Yeah, but again, I think this company got fat at the wrong time, and I've been in real estate 25 years. There's a moment in time where an asset class takes off, and all of the gurus and pretenders and all of this come in, and then the value of the product explodes. And then, through no fault of their own, in this case, regulation came in and took these assets and whacked them. I'll give you an example. So there was a house I read about in Palm Springs, which back in 2019-18, pre-pandemic, sold for like $310,000, right? Kind of bread and butter stuff.
Yep.
It was then bought and sold multiple times, all the way up to 600, and let's call it $600,000. It was like 620 or something. And then because of the STR craze, it sold for $1.1 million.
Airbnbers, people want to go play golf.
Right. But then Airbnb comes in and says, you have to be regulated only, I don't know what it was, 30 days, blah, blah, blah. That house now is probably worth 400.
That just eviscerates capital.
So the investors already toast because they had 25% in the game, right? 1.1, they put in $300,000. Right. They're done.
Right.
But now this lender who has got gobs of these is going to lose 30%.
Yeah. Well, sometimes there's not a solution to the problem is the reality. Maybe time is what it is.
Well, the problem is don't be a moron and gorge on the same thing.
Yeah, no. I'm saying that there's not a solution to high mortgage rates right now because there's just not enough spread. There's not enough margin of error for people to come in and undercut the system. As high and as terrible as that is to say, because it's so hard on people.
Yeah, that's why 2025 will be the last hard year. Again, it's not survived to 25; it's survived through 25.
Right.
I don't know what the numbers are, but when you look at the mortgage industry, something I read months ago. It's down 55% and probably going lower, right? From total mortgage originators to where they are today, probably going lower. And then real estate agents, I mean, man, I think I read a number the other day, like 78% of real estate agents sold 0 homes last year.
What? Is that just
0.
because people are on the fringe? Like, full disclosure, my wife at one point had a real estate license as like a backup tool, but never
Yep.
actually used it or
Transacted,
even
yeah.
really planned on it. Is it that, or is it?
It could. I mean, it has to be
people
some of
in
that.
the
Clearly,
business?
clearly some of
Zero.
that. 0. So
I,
again, why do I think 2026 gets better? It's because all of the pretenders will be gone.
right.
You can't survive. It's hard to survive on 0.
Yeah.
Right?
I've heard
So,
we have a couple clients that are real estate agents and brokers and own their firms. And some of the areas, they're like, we've got way too much business. And I'm like, well, I can assure you that based on the numbers, you are an amazing business person.
yeah, you are an anomaly. Keep going.
You are an anomaly, right? I can't wait to see how much money you make, when the times change, because you're killing it. Keep it up. And, obviously, that maybe 80-20 rule of like 20% are doing 80% of the business. I would imagine that's probably true.
It's 95-5 at this point, right?
Right. Yeah.
5% are doing 95%. But again, so I was thinking the other day, like, what would I tell a brand new real estate agent starting today? I would actually probably give them some encouragement. Because again, when you're a brand new agent, you don't have the expenses. You haven't went out and bought your 3rd lease. You haven't done anything. You haven't taken your life expenses up. Yeah, I mean, go for it. Build your network, learn, get in the, do it. And life, you have a 10-year runway where every year is going to be better than the year before.
Yeah. Yeah. What rings in my head, that Alicia Keys song where she goes, if you can make it here, you can make it anywhere. She's talking about New York City. It's like, if you can make it right now in real estate, like, holy smokes, hang on, because your growth and career are going to be a moonshot.
Yeah. You're going to have a great decade. And same for mortgage. Right. Mortgage has been really tough. But if I'm right about interest rates and we see a move down in 26 and then 27 is a little better in 26, not only will purchases go up, but refis will start coming back.
Totally.
And that's just a
non-existent market right now.
Yeah. It's just not there. So again, I think, good news is we only have 11 months to go. Right. We're already done with 1 month.
Also, the good news is mortgage, real estate, etc. 3 years ago, like, you made just
I hope you save some money.
Right. That's the point. It doesn't make it feel any better right now. I totally get that and sympathetic.
If somebody wanted to follow you and reach out, what do they do?
Yeah, follow us at Life Goal Investments. We're on both Instagram and TikTok doing daily videos, just having fun.
Yeah, you do a great. I have no idea how you get so much value in 60 seconds. You're a genius for doing all that.
Take every word out you can. That's what I've learned.
Take care.
Thank you so much.